So here we got the 1 year chart daily candlesticks for the SPY. Clearly showing the all-time high back in January, and the downtrend that's followed as long with the bounces, the bear market rallies along the way. You know, around 10-12% bear market rally here and nearly 15%. So the last time I recorded a SPY analysis video was on August 31st. We were around 396. We had set a higher high, tested this 200 SMA, and then came down and was testing this 50 SMA since we broke under clearly and actually set lower lows. A new 52-week low at 357.04. So it was previously around 362. Now it's at 357. $5 lower. And so let's set up what happened here. So this low was heading into one of the FOMC meetings where Powell pretended as low he's going to look at the data before he hikes anymore. So the market got the narrative that they were flipping dovish, but inflation didn't peak. It's still high up. So they continue to hike. They've since done a 0.75% hike. So that whole narrative is gone, and they're talking about doing another one. So it makes sense. Not only have we came all the way back, it would make sense to go lower. If this rally was based off the premise that the Feds were going to flip dovish and start ending the hikes. But no, they're not. They've done it since, and they say they're going to continue to do so. And furthermore, if inflation does go down and they continue to hike, that's double negative on the margin and the leverage in the stock market, as real negative interest rates become less negative on both sides. So let's look at actually today's action as I record this on Monday. We were down around 5-6% in futures. We pushed up in the morning, bull trapped everyone, and then actually came all the way down to around 357.60. So only around 60 cents above that 52-week low we set yesterday. Not very bullish, but we did have this quick ricochet off. I don't know how natural it was, or if it was just a quick quant that loaded calls here and flipped them here, and setting up the next puts for the next leg down and trapping these call buyers. That's what I'm predicting, but I wouldn't surprise me at the same time. We just saw, as we look back at that 1 year chart, we just saw 362 to 430. So after we set this new low, I could see another bounce up to this, 385, 390 range I'm predicting. And it will be heavy as we look from this action and this action. Support and then resistance here, support here, temporarily resistance here. So I expect that to be very heavy the next time we get up to this 385, 390 range. But on the way down, under this 357, we got to go to like the 3 year chart to get a feel. So this is where we could see where the 52-week low bounced off of. This had spiked post-COVID and got rejected here, and now it's acting as support. Resistance turns support. But underneath this 357, I think we're going to be very soft till 353. So under 357, I'm expecting a quick drop to 353, and then next, the psychological 350 level. Underneath that, I do think we're going to be soft to this pre-COVID all-time high around 340. So get that right. Under 357, we got 353, 350, then 340. And that 340 is the pre-COVID high. Underneath that, we got 333, 334-ish will be the next support level. Underneath that, I'm going straight to the 325, which makes sense because let's look back at this. Let's go back and look actually all the way to the 20-year chart to get the long-term uptrend. So you could draw an uptrend right here and one right here, and they both collide around the near same level, around 315 currently. But as time pushes, it will go up to around 320, 325. So I'm expecting that pullback to this uptrend line if 350 breaks. 350 doesn't break and holds, I'll load. I'll start accumulating. Dollar cost average style, but on a very small scale, maybe 15% of my overall position, near 350. Knowing if it goes lower, I won't get stressed out. I'll be happy to load more. I do not want to get caught in this. We're so far off the all-time high, everyone's saying, but look how high we are off the low of March, or just the overall trend line. So when we look at the 5-year chart and look at the Fibonacci retracement, we can see from the bottom of the March 2020 lows to the top of the January 2022 highs, a 50% pullback would be 350, nearly 349. Here we are at 360. A 62% pullback would be 318. So around 60% or so. 58% is that 325 range. That's that overall uptrend on that 20-year chart. So I also want to go over what's driving this overall downtrend. When we look at this, we'll go 2-year chart to get the feel. Or no, let's go back to 3-year. When we look at the 3-year chart, we see this COVID crash. So it was the record sharpest crash in the stock market history, followed by the record sharpest rally. So real unprecedented times in the market. So I see a lot of people comparing this to a lot of, you hear, this happened in 1990, this happened in 1653. We're in an unprecedented time of just so much stimulus and loose money, where it's hard to compare that. So when we see this 60-month on the U.S. 10-year Treasury bond, we can see it bottomed out here in August, and since it's pushed from around 2.6% to all the way over above 3.8% today. But as that looks like a big move, we got to go all the way out, and I think this chart only goes to, 1994. You can see this has been in a downtrend, the U.S. 10-year Treasury note, downtrend until recently, and we broke out of it. And I think this headline best captures it. Global bonds are in the first bear market in 76 years based on 2 centuries of data, says Dutch Bank. 76 years. So this only goes to 94. So there's been just nonstop cheaper and cheaper and cheaper money, where things really need to restructure now. And a lot of companies, there's so many zombie companies barely making it. No unprofitable, just barely hanging on with their cash flow. And the indexes that are going to have to get purged out, and it's not going to be pretty. So the big narrative too of lately is that the job market is strong, the economy is strong. They're still fighting and denying the recession. Everyone that's paying any attention with common sense knows we're in a recession. But they're really pushing this narrative that we're not in a recession still. Don't buy it. They're saying we're not in a recession, GDP goes down. That doesn't matter. We got a tight job market. But let's really think about this for 1 second. Unemployment rate falls to 3.5% in September. Payroll rises. So the unemployment rate is down 0.2%. But at the same time, the participation is going lower. And we're going to talk about that. So pre-COVID, participation, and this is the U.S. Bureau of Labor Statistics. This is government numbers. So they could be even masking these somewhat. But even their numbers are showing the problem here. 63%. It got as low as 60.2% after COVID. And here we are at 62.3%. So they're acting like this job market is so strong and there's so little unemployment. But at the same time, all this jobs that recover is still just people going back to work from pre-COVID. And it's still not even what it was before. And then let's add in the extra grain of salt here. Nearly 70% of Americans are looking for extra work to combat inflation. So people are getting second jobs to combat inflation. And that's showing up on these numbers. And this isn't counting all these people that aren't participating, that are working under the table and in the black market to counter inflation and not pay taxes, as well as all these people online making money. You got to think about these Discords, whether it's what's that app where people watch video games, girls on OnlyFans. There's so much money getting made now online It's not traditionally getting made, that people aren't reporting. So Apple, so that's another thing. I want to go over the 1 year daily candlestick charts on the top holdings, because you can see how Apple is, SPY, here we are, $2 lower than the previous June low. We set the 357 52-week low. But more importantly, let's look at the top holdings. So Apple, this is what's interesting to me. When we set that June SPY low, Apple hit that 52-week low around 129. We're currently at 140. So that's $11 down to the 52-week low, which would put a lot of selling pressure on the SPY, which is back at that low. So let's actually do a line for a visual. We're $11 off the low. Not quite 10%, but not far from it on Apple. Microsoft, we are lower than the June low. And that's why I targeted this one today over Apple. I think this one's more oversold and a better value right now. We'll go over the PE in a little bit. But Microsoft, we'll go Google. Same situation. 52-week low, 102. Here we are breaking it. 97 today. So Tesla is pulling about all the way back down to its low, but it's still got about $14 or so to go down. And Amazon finally. Another situation like Apple, it had a low around 102 and now it's 113. So it does have 10% of downside to its previous 52-week low, which would put a lot of selling pressure on the Apple. So what I predict is what they'll do, what they've been doing a lot is, we saw it last week. Apple goes down 3 or 4% one day and every other stock in the market goes green. That's so rare. That's such a that doesn't happen a lot. And what they're doing is they're hiding the downside on one of these top 10 holdings with the upside of all the other ones. So while Apple's up, everything else is, Apple's down significantly. Everything else is up a lot. They did the same thing with Tesla a couple of days later. And why I'm saying it's a prop job is the next day they all the other stuff sells back off. So what I predict is Apple's going to head back down to this 52-week low. But at the same time, they'll usually try to hide the upside by algoing up like a Microsoft up to like this 240, 250 level while Apple goes down. And then when Apple has its first green days, this will slowly fade back down. They've mastered the ability to prop these indexes. So let's go over a couple more of the reasons why I like the Microsofts better than the Apple currently. Because when we look at the Apple, we all know that share price doesn't mean as much as the PE ratio. How much dividends are you getting compared to the share price? So look at Apple, 10, 11, 12, 15, 16, 17. PE ratio slowly growing up as that interest rates go down and pushes money into the market. Did you remember this 10-year treasury note? This goes down. Money's getting pushed into the Apple. They're pushing this growth narrative. But the truth is, it's just this low interest rates propping the markets, overpricing the stock. So here we are. But then here comes COVID. It pushes it all the way to 35, 34 PE ratio. Now we are down to 22, 23. But before COVID, in 2019, we're 15, 16. So we're significantly higher than historical values on this PE. But when we look at a stock like Microsoft, for example, it is a better situation on the PE. It's still an uptrend. But here we are down to 25 or so. And in 2019, we were 25. So it's pretty much just retraced all the way back, 26, 25. It was 2019, 20 or so in 2017. Up to 44 in 2018. But that's kind of a rarity. So it's overall uptrend. We're back to it slightly. Almost back. Could say it's testing the uptrend break, but it's not a chart. It's not really a stock. But I think this type, and then Amazon, let's go, Amazon. Same situation, see. It didn't get as high 2020 compared to the other tech stocks. And it's still about the same, so it's not as good as the Microsoft. We look at Google. And look at that, that's kind of cool. 18, which what it was. That's what it hit in March 18. So we're back to COVID crash levels on the PE, and actually lower than before. So what I'm saying is I'd start DCAing, dollar cost averaging, into this, Microsoft and Google lightly before I would the Apple, which I think has more downside on the share side. So let's also look at the fund rate. They're pushing the narrative. The Feds are so aggressive. They're killing the market. Oh no. It's crazy how they flip-flop. So they pretty much prop the market for 15 years, and as soon as they slightly just stop doing it as much, everyone complains like they're being, complete hawks. They're so aggressive. But look at the federal fund rate from 1955 to now. I mean, it's a joke. What I'm saying is if they had to push it up to this 4-5% level, it's going to put a lot of pressure, and it's definitely going to take that S&P to 325, 330 range, I think. If they get this federal fund rate to around 5%, and same with this U.S. Treasury note, if it heads up to this 5.5, 6% range, we're seeing 320. But look at Paul Volcker, 19%. I see people with the audacity to call Powell the next Volcker, or say Powell's even more aggressive than Volcker. That's some of the craziest headlines I've ever read, pushing that narrative. Look, Volcker had the federal fund rate at 19% to fight inflation that's less than we have now. That Powell's trying to fight with a federal fund rate at 2.3%. He tried to call 2.5% neutral. It's insane. So if they're really trying to fight inflation, here's the big thing. Let's look at the max of the M2 money supply. Non-stop going up, right? Progressively quicker until 2020, where it really skyrockets. But when we zoom in on this 1 year, we see something very clear here. March 2022, this is in billions of dollars. It's at 21.74 thousand. We did retrace to 21.65 thousand. But here we are, slowly creeping back up to 21.71 thousand. There has been barely any reduction in the money supply. So inflation will continue. And if inflation did go down, the way they measure it in the consumer prices, it's going to kill the revenue year over year on all these stocks. And that's what we're going to go over next. FedEx. The EPS fell 21% year over year, while their revenue rose 5%. So it's the same theme. The revenue rises not as much as inflation, because you have to rise the same rate as inflation to be the same. If inflation is 9%, you have to make 9% more than last year just to have the same revenue, inflation adjusted. So if it's 5%, it's actually a decrease in revenue. But more importantly, they've lost 21% of profit margin. So if inflation goes down, their revenue is going to get smashed. And unless they keep their prices up and start buying things for significantly cheaper, and their margins aren't going to go up. And maybe if they do, it will go up a little bit, but the revenue will still fall. It's going to be horrible for the next year. They really printed at all these stocks to the point where all their growth was priced in for so many years to come. All these good things were priced in, and nothing bad. And it's really going to set up. I call it the lost decade. They call it the roaring 20s. I call it the boring 20s. They killed a decade of investments. So more importantly, FedEx did it, but AMD is another sign. AMD is reporting that revenue for the quarter will come in at $5.6 billion, which is over $1 billion below their guidance. So that's another thing. Off this 52-week low, a lot of stocks dropped bad earnings, but then put good guidances. Very, real positive, speculative guidances that now they're retracing. So that's the new theme of the market. No matter how bad the earnings are, they'll just come out and put a unrealistic positive guidance, get everyone in it, and then change it a couple months later, and you can't do anything about it. So Netflix, for example, lost 1 million people, remember, subscribers. But don't worry, next quarter, they're going to get 1 million back. They don't know that, and I doubt they will, and we're going to see. So the same situation. AMD pushed away too high guidance. Now everyone's getting upset because the growth narrative on these big tech stocks is going to get crushed as interest rates continue to go up. So another situation is analysts lower the S&P 500 quarterly earning estimates, and you can see it on this bar chart. They lowered them 6.6%, the lowest since that first quarter of 2020, where the big money knew about the COVID coming, and then everyone found out it really got lowered. So that just shows it kind of quantified in a macro perspective, 6.6 overall percent and earning estimate lowered. Every sector besides energy, which is just going to take more money away from the consumers to put into, stuff they don't need. So I think that's about it. Under the 360, we got the 357, the 353, the 350. Then we go 340 and then 333. Underneath that, I'm going straight to 325 underneath as my targets, which is the overall uptrend. With Apple being the most overpriced top holding, then Tesla, then Amazon, and the least expensive, I'd say, would be Microsoft and the Google. And on the upside, real quick, let's go to the daily 1 year and go to the target, the heavy side. So over 365, it's going to be the obvious. 375, then 380. And it's pretty clear cut because when it goes to 390, I'd say there's not much between 380 and 390 in terms of resistance. But there is one part I want to talk about. 383.50. The algorithms were pinned to that level for so long. I watched it for weeks and weeks and weeks. 383.50. And now I see the same action at 363.50. The same person has it now pinned to 363.50. So above 380, 383.50, 390. Then we got this 398, 400 level. And then this 410. Back to this 50 SMA would bring us maybe to this 390 level, which I think will be heavy from all this action. This support, resistance support. So I think we're going to test this 350, maybe bounce back to 390, and then head back down again. As we realize there's not going to be any we need a huge influx of newly printed money to prop this back up. And we need exponentially bigger amounts of this newly printed money every time, which is going to be hard because they raised the bar so high. They didn't double down after 2008. They quadrupled down. This was ridiculous. This right here was 13 years of a fake bull market they printed up with low artificial interest rates popping. They quadrupled up. And here we are pricing the decade or two of positive earnings and growth into the market already, leaving a whole generation to dollar cost average into their 401ks into a ticking time bomb. So I'll start adding, 350, 340 range, take more on down to 320. And if we get underneath that, I'll start adding big. I don't want to start adding too heavily or, 360 long term and think it's going to go right back to this 480. I mean, in 2021, everyone was shooting 500 targets on SPY, 550 targets. It was ridiculous. Everyone was calling Bitcoin for 100,000 by the end of the year. Now, if we break down under this 357 level and do we're headed to pre-COVID levels. Pre-COVID all-time high, which was still after a forced 13-year bubble. And after 2 or 3 years of 8 to 10% inflation, people were down bad. There's no way there's not many stocks you could have bought in which you're up that you bought after, 2 or 3 months after the bottom of the crash, unless you sold into the push. But any investor that loaded, August 2020 and on and held, is probably down bad, unless it's the S&P, unless they're just holding this S&P or an Apple or a Google. But on a small cap or a medium cap stock, you're probably down 60, 70%. If it's a COVID stock, one of those Pelotons, you're down 90, 95%. You're getting crushed. If you're in one of those ARK innovation ETF stocks, these speculative tech companies. So that's it. This video is too long.